Right, good morning, good afternoon, and good evening to everyone. Welcome to the latest session of the VT Markets Trading Vault. Um, please, as always, please can we just do a quick audio visual check? Please, can you make sure, or please let me know in the chat that you can see me okay, you can hear me okay. You should be able to see my screen, which at the moment is a QR code where you can sign up for a VT Markets live account. Please also just give me a little heads up of where you're calling in from. Please let me know your sort of level of experience and what you're sort of looking to get out of these sessions as well. We much appreciated. Okay, great. So everyone can hear me and see me and everything. So Johannesburg, South Africa, beautiful part of the world. Malaysia, Oman, Holland, Southampton, not far from where I live in the UK, Bulgaria. Okay, very nice. UAE, awesome. So again, a big mix of people from all over the world. Please stay on until the end. We do have a free gold cheat sheet to give out to you towards the end of the session as well. So please do make sure you stay on the line for that as well. Okay, no experience of trading at all, Mikova. So look, hopefully you're in the right place. You know, this is a great place for you to learn how to trade and the basics as well. So, and this one, especially today, when if you're starting with a small amount of capital, how you can actually do so. Okay, so as always, we will go through the webinar. We will go through. Okay, somebody's saying the volume is low. Can everyone else hear me loud and clear? Please let me know if you can hear me. Okay. Okay, yeah. So, Jakob, everyone else is saying that the sound is good. So, please check on your side to make sure that your volume and audio settings are okay. So yeah, we will go through the content of the webinar. Please do come back to me if you have any questions in the chat box. I will endeavour to answer them as we go through, but there will be a Q&A at the end. So if I do miss one or I wait to answer one at the end, please do bear with me. I won't miss out any on purpose. It will be purely accidental. So please, if I miss one, please just post it back in at the Q&A at the end. So we're going to go through the content of the webinar, and then we will jump into some charts as well and go into some live trading examples and look at some levels for you to be able to take away from this as well. So, okay, let's get into the webinar. Okay, so today's webinar is all about how to start trading gold with just $100. Now, one of the biggest things that traders have, certainly retail traders, is being undercapitalized, is not having vast sums of money to be able to get the returns that they want. However, starting modestly with small, modest amounts of capital doesn't mean that you can't achieve your goals. You may need to be a bit more patient. You may need to be a little bit more realistic. But even from small amounts of capital, they can become significant over a period of time as long as you build the right habits and the right processes from the very beginning. Okay, and you need to find the right brokers that will facilitate you being able to do this as well. Okay, so today's going to be about how to start trading gold with just $100. Okay, so for those of you who don't know me, I know most of you have been on these webinars. We've been running these for a while now, and most of you may know me, but anyone who is brand new, my name is Ross Maxwell. I am VT Markets Global Operations Strategy Lead. It's my responsibility to provide high-level educational content for traders of all levels. So that is whether you're brand new, like some people here, Martin, who's got some experience, or whether you're an experienced trader looking for a little bit extra. Sure, bear with me. There we go. Then hopefully you will be able to take something from these sessions. Okay. I'm also a professional trader and an investment manager. I've got more than 20 years experience in trading the financial markets. It's actually 25 now. I started when I left school in 2001 in London. I went to Hong Kong and now I'm a fully independent trader. I'm also an award-winning trading coach and mentor and founder of Keyzone Traders, which is an online trading education company. Okay. I will have to just check the chat box every now and then. Bear with me 1 second. Just need to close these down. Yeah, bear with me 1 second. Okay. So gold. So as I say, we're going to focus on gold, which is one of the most highly traded, if not the most traded asset. It is highly liquid. It has tight spreads. It is it is the oldest instrument that is traded in the financial markets, and it is one that everyone is aware of, everyone that has an appetite for, and one that is most familiar with a lot of people. So gold has been seen as a store of value for thousands of years, and this is why it's one of the the oldest and most trusted assets out there. It is viewed as a safe haven asset. So during periods of financial crisis and geopolitical instability, investors and traders flock to gold because they see it as a safe asset that will keep its value and keep their capital safe. It's highly liquid, as I say, with tight spreads and can be traded 24 hours a day across global markets. But with VT markets, we have a new XAU US dollar 24/7, which is gold 24/7 instrument, and it can now even be traded at weekends. So you can always gain exposure to gold. One of the biggest issues around a lot of financial instruments is that you take risk over the weekend. So when a market closes on a Friday, if there are big events, especially like there are at the moment with the ongoing geopolitical tensions and issues, if something happens over the weekend, you can see big gaps in price, big gaps in the value of instruments over the weekend, and you can't react to it. You cannot do anything about it. With VT Markets' new Gold 24/7 instrument, you can react even at weekends, so your risk is reduced because you can reduce your exposure or increase your exposure or just manage your risk and manage your exposure to gold even during the weekend, which you was not able to do before. It has easy access for retail, institutions, and central banks, and is standardized globally in US dollars as well. Okay, so when we are trading gold, first of all, we need to understand what makes the gold move. Okay, so gold reacts to a mix of investor sentiment, macroeconomic, and geopolitical factors. Now, one of these and especially at the moment, one of the biggest factors is the US dollar. So gold often has an inverse relationship with the US dollar. So as the US dollar weakens, gold will go up because becomes cheaper for investors to buy gold. As the US dollar goes up and gets stronger, gold generally goes down because it becomes more expensive for investors to buy an ounce of gold. So yields and interest rates, lower real yields make non-yielding assets such as gold attractive, and inflation as well is a huge one. So this is another thing that's playing into the gold at the moment. Gold will benefit when investors look to hedge against inflation risks, and we're seeing the inflation from the war between the US and Iran. At the moment, inflation seems to be under control. However, there are potential risks with the increased oil prices on inflation, which has an impact on US dollar, and also the next thing that can move gold, which is the Fed policy. And again, this is another key focus for the markets and which is impacting gold price at the moment. Expectations around Fed policy and rate movements will move gold sharply. So there's this, towards the end of last year, there was expectations that interest rates would continue to drop slightly, but due to the inflation risks, due to the ongoing political tensions and potential inflation issues, there is this sort of balance and potential for not just rates to not decrease and stay higher for long, but even potentially maybe increase rates. So this sort of balancing act at the moment is going to be, and Fed policy is going to have a big impact on gold price over the coming weeks and months. Geopolitics. So again, this is one of what we've been talking about. Conflict and uncertainty can increase safe haven demand. And then also for short-term traders of gold, technical level. So gold is a great technical asset. Okay, so it respects support and resistance very well. It creates momentum for momentum traders. So for short-term traders, gold is a really good asset to look for support, resistance, and momentum trades. Okay, so fine. Please do let me know if there are any questions. But let's keep it moving. Okay, So starting with just $100, okay, many traders make the mistake that with a small account, they need to trade more and in bigger size to grow their account. Okay, so they will think, right, I've only got $100. I need to turn that into $200. I need to turn that into $500. I need to build that really quickly. How do I do that? Instead of trading at 1% of my account and trading a risk of $1, I'm going to trade $10 an account, $10 per trade, which is 10% of your account. And I need to take, instead of like 2 to 3 trades a day, I need to take 5 to 10 trades a day. Well, if you're trading $10 a trade, you take 5 trades in one day and you lose all 5, you've lost 50% of your account, and you've now only got $50 left, which means you now need to make 100% of your account just to get back to break even. So we need to think about survival. We need to deposit that $100. We need to risk 1 to 2% per trade. So build the right processes, build the right mindset, build the right habits. Risk just at 1 to 2% per trade, which is only $1 to $2. Take a maximum loss of 2 to 3 trades per day before you stop, go away, reassess your performance. Trade fewer but higher quality setups, and use a broker that offers micro lots so that you can continue to risk sensibly in line with your account size. And VT Markets does allow you to trade micro lots. And this is a big thing as well. When you're looking to trade gold with a small account, you need to be able to have the ability to trade micro lots so you can keep a responsible amount of risk per trade, which is that $1 to $2 to start with. Now, also, just let me know in the chat, are many of you trading with an account size of around $100? Is this something that you need to know? Is this something that is going to become very useful for you? Please do let me know as well. And this, to be fair, is for, it doesn't, even if you've got a larger account than $100, but a relatively small account, this theory, this ideology, and this process, and it can all be placed into action relative to your account size. So to be able to grow your account over time, you need to avoid making the same mistakes many traders make when starting with a small account. Okay. Now, the general mistakes that traders make when starting with small accounts is they, as I say, oversized positions. So rather than risking sensibly of that 1 to 2% per trade, they actually risk 10% per trade, 5, 10, sometimes even 20% per trade, which is just really irresponsible, and it's going to lose your account very, very quickly. Not trading with a stop loss. So again, allowing emotions to dictate, no stop loss, don't want to take a loss, and then one trade can wipe you out. Chasing new spikes and trying to catch every move. And again, this is trying to trade every single trade, trying to increase the number of trades that you get. You have this feeling that if you miss out on a move, therefore you've missed out on this opportunity to increase your account size and get to where you need to be. But actually, you need to stick to the plan, stick to the process. If the trade isn't part of your plan, then you leave it alone. Okay, so they go chasing news spikes where there's big movements in the market, trying to get some of that move. And again, feeling like you have to double that account quickly, feeling like you have to go from $100 to $200 to $500 in very, very short spaces of time. If you can make 100% returns in a very short space of time, you're probably either you've got very lucky, the markets are running extremely hot, or most likely you're trading very irresponsibly, and you are going to get caught out eventually. Okay, and another thing is adding positions and increasing the size of losing trades. Another big issue for traders who are trying to increase their account, because what happens is they feel like they cannot realize a loss, because if they realize a loss, they've already gone from $100 down to $90, $80, $70, $60, $50, and all of a sudden they lose big chunks of their account, and that mountain seems much, much bigger. So they add to positions to try and get it back. But again, these are all decisions based on emotions, and these will all eventually catch up with you and have a negative impact on your trading and your trading account. Okay, so just go through, see if there's any questions. So again, as the guys have said, there will be a free gold trading cheat sheet giving at the end of the webinar, so please do make sure you stay on to receive that as well. Okay, so risk management. Okay, your stop, and this is really, really important. Okay, your stop should determine your lot size and the amount you risk, not the other way around. the number of times in my trading coaching that people have come to me and said, I'm in this trade, where should my stop be? And it blows my mind, because it's like, well, if you don't know where your stop is, how have you determined your risk? How have you calculated your risk? How have you calculated your lot size? Because ultimately, if you're trading without, if you don't calculate your risk based on your stop, you basically have unlimited risk, because you don't know where your stop is. Okay, so you need to determine your stop first. So you determine how much you're prepared to lose, what is a sensible amount of your account. So, for example, if your account size is $100, you're risking 1%. That's $1 you need to risk. If you're risking 2%, that's $2 you're going to risk. You work out where your trade is invalidated, and then you have your stop placement there. Okay, so for gold, if we're buying at 4,450, and we believe that the trade is invalidated below 4,400, we might have a stop at 4,390, and therefore we have a 60-point stop. And we know we're going to risk $1. Therefore, we can calculate our lot size based on those factors. Okay, so we must know those factors before we calculate our lot size. Because if you lose 2 or 3 trades in a row, you stop and assess trading performance and work out whether the trades were valid to see and make sure you are following the right process. Okay, so any other questions at the moment, guys, before we go through the last few slides, and then we will look to jump into the trading as well. Okay, perfect. So step by step for trading gold. Okay, hang on, one question's just come through. Can you explain with examples the US dollar price action and inflation up? Jakob, do you mean in relation to gold, or do you mean just in general at the moment in terms of inflation and how that's impacting US dollar? We can cover that towards the end. How to emotional control. 300 is a good amount to start with. With $100, can we trade the normal account instead of micro lots? Farik, with $100, I would suggest you really probably do need micro lots, because you're not going to be able to risk sensibly, like responsibly with your account, trading full lots, because one lot will wipe your whole trading account out basically. So you need to be able to trade micro lots. In regards to, is 300 good amount to start? Any amount is a good amount to start in relation to the capital you have available to commit. As long as you trade responsibly. Okay, so you can trade with any amount to start with: $100, $200, $300, $500. It doesn't really matter. Whatever that amount that you are prepared to lose and you're capable of losing, that is a good amount to start. But you just need to make sure you do the right processes and follow the right responsible risk management techniques to make sure that you don't blow that $300, because whether you've got $300 or $300,000 or $3 million, that is not a good amount to start if you're not going to follow the right processes, because you're going to lose it all. So it doesn't. The amount is fine as long as you approach it in the right way. And in terms of emotional control, we will come back to that towards the end, if that's okay. When we have time, we'll keep on track at the moment. Can you explain examples, the US dollar price action and inflation with gold? Yeah, we'll go into live examples shortly, Jakob, and then hopefully we can we can go through that. Okay, so step by step for trading gold. Okay, determine your bias. Okay, so this is the first thing you need to do. You need to work out which trend the market is moving in, and then you want to only trade with that trend. Are we in an uptrend, and then you only want to look to buy? Are we in a downtrend, and therefore we only want to look to sell? Or maybe we are range bound, and therefore we just want to play the outer edges of that structure. We do not want to get involved in the middle, because in the middle, that is a lot of chop, or what we call choppy price action, two-way price action, no clear movement direction. Therefore, we don't want to be involved. Okay. We then want to look for technical levels of support or resistance to determine your location. Do not trade unless price moves back into that area. So again, one of the big mistakes a lot of traders make is they would go, right, gold is moving up, therefore I'm just going to, they're too keen, they want to get involved too much, so they're chasing the market, and therefore they just buy the market without any real clear plan or without any good trade location. Once you've determined your bias and you can look for a support, so say you want to buy the market, you look for a support area and you only trade if the market pulls back into that area. If the market doesn't pull back into that area, you do not trade, okay? If the market continues higher, you look for further support, and then you look for the market to pull back into that area, okay? So it's really important that you only trade with the trend from clear areas of technical support or resistance. That will give you the highest probability trade locations. You can then wait for confirmation. So, for example, a candlestick pattern that you put into your trade plan and say, okay, well, once the market hits that area, it might be a moving average, it might be an area, a zone of support or resistance. Once the market hits that area, I'm going to look for a pin bar in the direction of the trend, and then I'm going to enter. You want to create your trade parameters. You determine your entry, your stop, and your target. Make sure you have calculated your lot size to match your risk parameters as we went through in the slide previously. And then you need to accept the outcome, whether it's a win, whether it's a loss, as long as you followed the process, followed the correct processes to determine your risk, followed the correct processes as per your trade plan. You need to accept the outcome. Do not let emotions dictate your decisions. Do not move your stop. Do not add to your position. Just accept the outcome. Okay? Okay. Okay, so couple of questions coming in. What is the minimum recommended capital to trade gold at the normal account? You need a much larger account, really, for it. I would say sort of in the thousands before you can trade a normal account at reasonable and responsible levels. How to draw support and resistance. Okay, so we have covered that in previous webinars. I won't go into loads of detail. We will cover that slightly when we're going into the charts, which we'll get onto very shortly, because I realise we're going on a little bit here. But we will cover that when we get into the charts. However, there has been a previous session where we've got into much more detail than I'll be able to cover today on previous webinars. So if you can go back to the recordings of that, that should cover it in more detail. What do you use to determine the bias, and in what time frame you determine the bias? Okay, Evans, we will cover that as well once we move on to the live trading. Okay, so compounding. Now, this is a really important part of this session, okay? So compounding is a strategy of using your gains to increase your size naturally whilst also maintaining prudent account management. So at first, compounding seems pointless because the gains are so small, okay? But consistency in execution is key, and over time, those gains become more meaningful. I'm going to go through an example to show that in a minute, okay? Losses also compound. So a 50% loss requires 100% gain just to recover back to your original account size, as we mentioned earlier on in the session. So you want to focus on the process. You need to protect your capital, build consistency, increase size gradually. That will help you, one, emotionally deal with increasing the account gradually, but two, it will build the habit so that once you have a larger account, you continue to do the same things rather than then having to rewire all the habits that you've built, which are bad habits of like oversizing, etc., and you can continue to trade responsibly. Okay. There is a link, Amit, for previous webinars. If the guys could please post that in. There's also a link in there at the moment to register for our next webinar as well. Okay, so on to this example of compounding. If you make 5% on a $100 account, you make $5. Okay, so say you make 5% in a month, which is a very good return for the markets. Okay. You make $5 in a month. That seems like a small amount for the amount for a month's worth of work, okay? And a lot of people get disheartened by that when they sit there and think, I've worked all month and I've made $5. What's the point almost, okay? However, the next month, if you use the gains to increase your size and continue to trade 1%, you make a further 5%, you will now make $5.25. Again, very small amount, seems almost, and now you've only made $10 in 2 months, $10.25 in 2 months. However, at the end of the first year, you will have made 80% returns on your account rather than 60% returns had you kept position sizing the same. So you will increase your returns by 20% just by compounding over the course of that year, month by month. After 2 years, you would have made 220% on your original account balance, as opposed to 120% had you kept your trade size the same. Again, so that's now 100% returns more by compounding had you just kept to the same stake sizing. After 5 years, you will have made 1,770% on your original account balance, as opposed to 300% had you kept the same position size. So again, you can see how if you keep compounding, the gains increase exponentially, whereby over a period of time, they really compound to make a much more meaningful amount. Okay, so it requires patience, it requires taking time, it requires looking at the bigger picture, it requires to stay on path to get to that point, but they do become worth it over a period of time. And if you compound, those gains become exponentially more. So that's like in the end, after 5 years, you're making 1,470% more than if you just kept your original same account size. Okay, so the longer you compound, the bigger the proportional gains increase as well. Okay, so thank you very much. That's the end of the presentation. So we can now jump into the charts and have a look at some trading. You can just bear with me 1 second. Okay. Okay, please let me know that you can now see my screen, which should be XAU US dollar. Perfect. Hang on, bear with me 1 second. Actually, I'm just excuse me 1 second. Sorry. Okay. Okay. So perfect. Good stuff. Right. Okay. So this is the XAU US dollar. Okay, this is the standard one. Like I say, there is now a 24/7 gold instrument that you can trade, but this is just a standard gold thing. And okay, so depending on your time frame that you want to look at, so somebody asked a question about what time frame should you determine your bias, or to determine your bias. Okay, I would look at 2 time frames. Okay, I'm not going to go too much into time frame correlation because again, that's a bigger discussion for another time. But I think a lot of times people will overcomplicate this process. Okay, so they will sit there and go top-down analysis. Everyone goes like, okay, look at the weekly, daily, etc., etc. But actually, on the daily, you can see that we have had this really strong downtrend, probably just breaking it to the upside here a little bit. But really, what is happening on a daily chart does not impact the 15-minute chart too much, or a 5-minute chart too much. Okay, especially if you're a short-term trader. If you're a longer-term trader, you need to look at the weekly, you need to look at the monthly charts, and daily, weekly, monthly to look for those sort of patterns. But as a short-term trader, I tend to advise people to go, right, look at your execution time frame, look at 1 time frame higher. Okay, so on the 15-minute, you can see we're clearly in an uptrend. Okay, you should be able to see that left to right, the market's moved up. That is fairly obvious. Okay, it should be fairly obvious to anyone. You don't need to like draw loads of lines and stuff like that. Just get an idea for where the market is moving. Okay, on the hourly, you can see we're a little bit more sideways. Okay, so does that mean that we should not trade a buy on the 15-minute? No, it doesn't. We are in an uptrend on the buy. We can see that we have got some room here up until we've got an area of resistance up here, okay? So we've got an area of resistance up here on the higher time frames. Actually, probably want to move it down, just probably a bit of a false break. So area of resistance there. So we're on in this uptrend, and we can see that we have some room still to go on the higher time frame to get to the resistance. We wouldn't want to be taking a buy trade into this area. Okay, we would not want to take a buy trade into this area because that is resistance on a higher time frame. But if we're executing on the 15-minute, we can look to areas of support on here. Okay, so we've determined that we are in a buy in an uptrend, so we want to look to buy. So we need to look for areas to buy from. Okay, so the main area that I can see on this chart to buy from is this area here of support. Okay, that is one area. Below that area of support, the market probably turns negative again. So, you know, there's another minor support in here. If you went down to a 5-minute chart, you could probably see some support in there. So if I just turn these green. Okay, so what you're doing then is you are saying to yourself, okay, so I have identified a bias on my execution time frame. Okay, I have checked the higher time frame to make sure that there's nothing against it. Again, if we was in a clear downtrend on the hourly, I would probably sit there and say, right, okay, we do not want to trade this. But we're not in a downtrend, we're just a little bit sort of sideways and we're on our way up and we've got some room to the next resistance. Therefore, we can still look to buy on our execution time frame. Okay, and therefore we then monitor and look for areas of support to potentially buy from. Now, if the market does not come back into these areas, we do not need to buy them. Okay, we also want to have a look at a little bit of price action. We've made a lower high here. This could look for a deeper correction back to this area here. We can then look for our confirmation signal, our candlestick pattern to look to get long. Okay, now then, that is if we are trading lower time frames. Okay, and somebody asked, how do we determine support and resistance zones? Again, so I'm not going to go into too much detail, but what we want to look for is we want to look for clear swing areas in the market that have reactions, strong reactions, both as support and resistance. So this area here, really strong area of support, bit choppy here, but then we have a really strong area of resistance where it connects with it here, breaks through, retests, really strong reaction support. So there's clearly liquidity in this area, okay? And that is what we're going to identify is areas of support. Looking to the higher time frame, we've got 1, 2, 3 reactions, very strong reaction, a fairly strong reaction, not as strong as this one and certainly not as strong as this one here, but we've got some strong reactions from resistance, multiple reactions. Therefore, that is our area of resistance. Okay, so that is what we're looking for. We're looking for multiple strong reactions, clear, decisive reactions from areas to determine support and resistance. Okay, so hopefully that is clearer there. If we are trading higher time frames, so let's just remove these for a moment. Okay, and we go to the daily chart. Okay, now the daily chart is slightly different. Okay, so the daily chart, we actually have a bearish bias. Okay, we can clearly see that we've been in this downtrend. Now, you know, if we were to draw a trend line sort of going down there, you can sort of see that we have broken this trend line to the upside and potentially we're moving higher. However, that does not automatically make us bullish on the higher time frames. Okay, on the weekly, you can see we have been extremely bullish and we're just coming down down a bit and we are a little bit weaker. We've seen quite a strong sell-off here. So what we need to do now is we need to look for areas of resistance. And those areas of resistance, one, they're not very clear actually here at the moment on gold because we've seen quite a lot of volatility. We've got one around there. And probably the clearest one is around here. Okay. Again, we've got support, strong reaction, broke through, came up, retested that area, broke down, and that's it. So we've got two areas of resistance here to look for. Okay. And what you probably sit there and say is, okay, on the higher time frame, we have had an extremely strong bull run. We've had a good correction. If we start breaking above these levels, then we are going to change our bias and therefore use these as support. Okay, so we can use these as resistance, but if we don't get our signals and we start breaking through them, then actually very quickly we want to change our bias back to being long and looking for buys, and we can use these areas as support instead of resistance. Okay, so does that make sense, guys, for those people that has asked those questions? Perfect. Great stuff. Brilliant. Okay, cool. Now then, so there was another question in relation to examples, the US dollar price action and inflation. Okay, so basically, you can see this in the gold chart in terms of that inverse relationship. Okay, so this area here is towards the end of February. So this area here is towards the end of February. This is when the war started. This is when America started attacking Iran. Okay, and you saw this really deep correction. Okay, the reason that happened is because US dollar at the time got stronger. So there would have been an idea that because there was geopolitical tensions, because there was conflict and everything like that going on, investors may look to gold for safe haven demand, okay, which would have actually given gold a boost. However, what actually happened is because of the higher oil prices, and the spike in oil prices and the potential for oil prices to stay elevated for a longer period of time, that provided a real and present threat to US inflation figures. Now, or global inflation figures, not just US global inflation. Now, if global inflation started to rise again, having just come under control, central banks and specifically the Fed would have been forced to increase their interest rates to combat the inflation. An increase in interest rates increases the strength of the dollar, and therefore that was seen as the more prominent factor because the increase in the dollar weighed on gold because of that inverse relationship that gold and dollar had. Okay, because the dollar all of a sudden the dollar strengthening all of a sudden made gold much more expensive for investors to invest in gold and to buy gold bullion. Okay, so that is what you can see playing out here. And then more recent, like a lot of this sort of upward move was because the dollar was because inflation started to come down. Okay, and therefore there was the potential for the Fed to decrease their rates, which you saw, and that was why, and that weakened the US dollar, and therefore this strengthened gold. Okay, so plus there's a lot of central bank buying, etc. All of those sorts of things that we discussed earlier on in the session. This move up on gold over many months, it was almost like the perfect storm for gold. Everything that could boost gold was going on, which helped drive gold to the record prices and drove that record move higher. So for Rick, if trading the 1 hour, look at the 4 hour or daily. You can look at either one, but what I would say again suggest is don't look at too many. Don't overcomplicate the process. If you're looking at the 1 hour, you can look at either the 4 hour or the daily. Just remember again, like you don't want to look at a monthly chart if you're looking at a 1 hour, looking to trade on a 1 hour. But there's not much. The daily is just a 4 hour chart condensed slightly. Okay, so there's not going to be huge. It's still going to be giving very similar data, just in a slightly different sort of like compressed or expanded state. You don't want to be looking too far out. So 15-minute, you can look at, and 1 hour, maybe a 4 hour if you wish. 1 hour, 4 hour daily is fine. 5-minute, you don't really want to look at anything higher than an hourly chart. Those sorts of things. Okay, so just don't go too far out. Don't zoom too far out because it becomes less relevant for the time frame that you're executing on. And again, a lot of people seem in trading, they try and get like a specific way, like they try and look for this optimum or utopian sort of process. What is important is consistency. So there's no point looking today at the 4 hour to determine it, and then next week the daily. Okay, keep the process consistent. That's what will keep your execution and your trading consistent, which is the main thing. Marcus, we have discussed candlesticks and confirmations in another recording. Again, please go back to the recordings. The guys have put the webinar recordings in the chat box, so you'll be able to access them there, and you can see it in much more detail. Would I mark out support if the bias clearly is in a downtrend? Yes, I would still mark out support. Basically, if I'm in a downtrend, I would mark out higher time frame support because you do not want to sell into higher time frame support. Much like we did with that 15-minute chart where we identified the higher time frame resistance. I've deleted it now, but we had this higher time frame resistance up here, and when I went to my 15-minute chart, I was like, right, we've got some room, but I don't want to be buying into that. So you can still mark resistance for your higher time frame, the 1 frame higher, because you don't want to be, even if it's with the trend, you don't want to be buying into higher time frame resistance. Equally, you don't want to be selling into higher time frame support. Okay, so hopefully that makes sense. So yes, it's still very useful to mark those out. For the 30-minute MAR, you want to use like a 4 hour chart would be fine for the higher time frame. The only way to have the same lot size on every trade is to use a fixed stop. So if you decide to have a 20-point stop, for example, then you can always use the fixed value. The problem with using with that is when volatility increases in the market, and you're using a 20-point stop, that could be too much that you're going to keep getting taken out trades because you're not allowing for the volatility you're not widening your stop to allow for the volatility. Equally, if you use a 20-point stop and volatility dies and really decreases, then your stop is probably too wide, and therefore your target is going to be too wide, and you're just not going to be able to hit your targets. So it's about keeping it in line with volatility. Okay, so if you want to use a fixed lot size, what I would suggest is, and we use this, we've discussed this before, is use the ATR to determine. So bear with me a second. Use your ATR to determine your for the volatility in the market. Where are we? What is the average true range? Average true range. There you go. So use the average true range to determine your current ATR. Determine a stop based on that. So you might just go like, okay, full one ATR. Okay, so ATR, generally speaking, at the moment is around 12 to 13 points on a 15-minute chart. Okay, so you might go, okay, I'm going to use a 12-point stop at the moment on all of my trades, or maybe 1.5 ATR, so like an 18-point stop, and then you can determine your lot size, and you can keep that consistent for that session. And then the following day, you check your ATR again, and if it's the same, you keep it the same. But when volatility spikes and increases, then you need to decrease. You need to increase your stop size and decrease your lot size in relation to that. Does that make sense? Okay, so use the ATR, the average true range, to determine your volatility to be able to keep it. But you can do that session by session rather than trade by trade. So if you want to keep it, you can just calculate that before you sit down for your session. It's very simple and very easy. That's the way that I would advise to do it, because if you kept the same lot size on every single trade during periods of low volatility and high volatility, it's just going to be too much. What's the ticker symbol for gold 24/7 on Trading View? I believe the ticker is XAU USD 247. That should bring it up. Okay. And again, yeah, there will be the free cheat sheet. So we've only got about 10 minutes left. Please do stay on the call to receive that cheat sheet and at the end of the webinar. And again, yeah, just to really stress the importance of that 24/7 gold instrument. One of the biggest risks, especially at the moment, is Donald Trump seems to have liked giving out information or creating movements in the market over the weekend with Iran. So having access to that 24/7 gold instrument really helps traders manage their risk and manage their exposure to gold, even over the weekend when the markets are shut. Okay. Yeah, we can try. I mean, I'm not going to force a trade. There's if you force trades, that's not prudent trading. But you can look, certainly if you're looking at a lower time frame trade. If you bear with me a second. Kelly, no, it's a new instrument. 24/7 gold is a new instrument. It's only been available for the last couple of weeks, so it's a brand new instrument that BT Markets have brought out. And please do utilize it to help you manage your exposure over the weekend. It's a really, really great tool to be able to help manage your risk. See, there's not a lot of momentum around at the moment. So again, this is a 1 minute chart. Again, there's not really a trade to trade here, but you could look for sort of a breakdown. You've got quite a nice strong support area here forming. Bear with me. We've got a really nice strong support area forming here. Okay. So what you could look for in this is, okay, so we could look at, this is a 1 minute chart. So you look for the 15-minute here. If you break down there, you've actually got a bit of support coming in here. That's down into the support area that we spoke about, actually, so you probably wouldn't want to trade. I was going to say, if you've got a bit of support there, you could look to break down and retest that. But actually, if you look at a higher time frame, this area here is one of those areas of support that we spoke about. So you actually wouldn't want to trade into that, basically. So yeah, unfortunately, there's not really a lot. The market's quite choppy today, and there's not really a live trade to be had, Jacob, I'm afraid, at the moment. But you could certainly look to this one, or you could look to this area down here. If we get a move later on, look for some form of, candlestick pattern, some sort of reversal pattern there to get yourself long. Okay. So yeah, just go trying to get through these last couple of questions. I was not aware there was 24. Oh, yep, sorry, Kelly, I've answered that one. Will this trade recording be shared? Yes, again, James, all recordings. There's a link to all recordings of all previous webinars as well. Does 12 points in ATR equal to 12 pips? It depends sort of like how you determine your pips and stuff, and some brokers calculate it slightly different. But 12, it's $12. Okay, so this is $12 worth of movement. Okay, so it's not 12 cents, it's $12 worth of movement, which is generally probably considered 1,200 pips. Okay. In a 15-minute entry, bearish or bullish trade, how will I know what are the targets or TPS. I'm not sure what you, if you could clarify what you mean by TPS. But what are your targets? Again, I would always advise for going for a minimum of 1-to-1 risk to reward, so 1-to-1 target. So wherever you're, so if you've got a 12-point stop, you need to go for a 12-point target minimum. What you should be looking to do is you should have a system in place backed up by data to determine the most optimum target. That might be 1.5, 2-to-1, or you want to target the next area of so if you're selling, you want to target the next area of support where the market may react from, and make sure that that is at least 1-to-1 away. And it might vary your risk to reward, but you want to be looking for areas that the market could react from to maximize your profit. That sort of comes from a little bit more experience. Yeah, so take profits. So you'll take profits, exactly. Take profits, targets, exactly same thing. So you want to determine, maybe initially you just go for a standardized, 2-to-1 target, 1.5-to-1 target, whatever your data suggests. And then over time, maybe you can, as you get more experience and better with it, identifying support and resistance. If you're selling, target the next area of support. If you're buying, target the next area of resistance, and that can increase your overall profit potential, overall risk to reward. You can just manage your trade along the way to reduce risk, reduce exposure, and let profits run. Is a gold trading cheat sheet today the same during your session in June? Because I missed the June session. I got Alice, if you could confirm that to Farik, that would be great. Got time for a couple more questions. If not, we can have a look at maybe a 4-hour chart. We haven't done that yet. So we've got a really key, actually, a really nice area. So you can see here on the 4-hour chart, we've seen this break up. Okay, so this is a strong uptrend. Okay. Yes, the cheat sheet is the same. Perfect. We've got a really nice support area in here for the markets. Okay, so this area here would be a very nice area to get long if it pulls back into it. Another nice area, if we pull back even further, would potentially be retests of this area here. Okay, so this is the breakout area. You can see a nice, really strong reaction. So generally speaking, the first tests of when so basically when we get these really strong resistance areas, really key swing areas in the market, and then we break through impulsively like we did here, really strong candles. The first test of these high liquidity areas often provide really good opportunities to get long, even if it's just for a small reaction. Okay. Okay, so Farik's asking if you could share the lot size calculator as well. What indicators, so Damir's asking, what indicators do I use to recognize the situation, i.e. the moment to enter a buy? So if you're, right, so I use very few indicators. I think indicators create cognitive overload, and people use indicators to try and look again for this utopian and perfect entry, which doesn't exist in trading. So you just need to create a process and follow the process. So you can see here, the only indicator that I've actually got on the chart is the ATR. Another indicator I would be absolutely okay with is a moving average, and you can use moving average as dynamic support or resistance. Other than that, all I'm doing is I'm identifying liquidity. Again, I can't go into too much detail here because we're running out of time, but please do look back at the previous recordings around how to identify these liquidity areas. You'll then need to exercise patience for the price to move back into those areas, and then you can either enter as a limit buy or limit sell order if you're experienced, or if you're new, maybe you want to wait for confirmation. So you want to look for a candlestick pattern, a pin bar, a engulfing bar, something along those lines to give you the confirmation that the market is going to move back and use that area as support as you had expected. Again, there is another webinar that goes into much more detail around those candlestick patterns. Again, please do check previous recordings because you'll then get the information about how to enter those. So hopefully that clears that up. Okay, guys. Any other questions before we wrap this up today? Like I say, please stay on the line. Please let us know what you thought of the webinar. If there's anything else you would like covered, please do stay on the line to make sure you get that cheat sheet as well, that gold trading cheat sheet. I hope that this webinar has been helpful for you, for any of you that are trading those smaller accounts. My biggest advice, and hopefully the biggest takeaway that you can take from this, is you need to follow the same processes. You need to follow the same. You need to put everything in place the same way to be able to build the account and then compound your account. That is the most appropriate and sensible way of increasing a small account. Okay, so somebody just said, "Can I show an example of a candlestick in a chart?" Sure. So the one that I can see right here. Hang on, let me just hang on, delete this one here. Let me just delete a couple of these. Just quickly show you this. So say, for example, okay, we had this area here. Okay, we've seen it acts as resistance, breakthrough, hold a support, strong push up. So we use this area as an area of support. We see price move down, and we get in this engulfing bar. Okay, you can see this engulfing bar. We've got that bar there, and then the engulfing bar there, or pin bar, whichever way you want to look at it. It's a positive bar. That is your candles. That is your entry. This one here. That candlestick there is your entry, okay? Because it's a bullish bar. You're looking, so you identified the area of support. You waited for price to come back. You've got your bullish candlestick bar, and then you entered the buy. So you might enter. You can buy on the close. You can buy slightly above. You have your stop below the zone, and you target back towards this area of resistance up here. That would be a very simple way of trading that. Okay. So hopefully that. Hopefully that helps, Demir. Hopefully that helps, Demir. Kove, how can you learn to trade as a newbie? Keep joining these webinars. Go back over the recordings that we've had. The links in the chat box. Go back over previous recordings. Keep turning up to these webinars. That's the best way to learn as a newbie. Okay, so how to determine your lot size if you're going to risk $15 with a 100 pip move. Marlon, use the lot size calculator that was given out in the last webinar session. That will help you determine that as well. Okay, cool. Okay, guys, that's our time up for today. So hope you found that session useful. Yes, you can enter the pin bar if your trading plan says enter the pin bar. You can enter the pin bar. That's absolutely fine. Just again, keep making sure you follow the same process all the time. Cool, good stuff. Enjoy the rest of your days. Good luck with your trading, and I'll see you in the next episode of the Trading Fall. Cheers, guys.
Hi, Ross. You gave out the cheat sheet?
Sorry?
The cheat sheet, the cheat sheet.
Where I thought you were going to post it.
Oh, it's the last slide of your PowerPoint.
Okay. Sorry. Apologies.
Okay, perfect.
There we go. Apologies. So there you go, guys. If let me just share my screen again. Okay, guys. So there we go. So there's the QR code there. Please, if everyone can make sure that you can see my screen. Okay. Please scan that QR code for the cheat sheet. Can you just confirm you can see my screen? Okay, everyone. Can everyone see my screen? Okay. Can everyone get that QR code? Okay. Perfect. Um, is there another way? Bear with me 1 second. What I can probably try and do, if I scan it myself and get the link, I can try and post a link into the chat room. If you bear with me 1 second, please, guys, I just need to send this to myself.
Ross, don't worry. I can give them a link.
Okay, perfect.
Yeah.
Thank you very much, Kelvin. Okay, so the link to that cheat sheet is now in the webinar chat as well. Okay, guys. Right. Again, thank you very much for joining the webinar today. I look forward to seeing you on the next episode of the Trading Vault, and good luck, everyone, with your trading. Cheers, everyone.